and we will not distribute or sell your information to anyone.
All right. Well, how is everybody doing? We had an interesting day so far. We played a couple of things. We played oil as it went to 72. Oh, we're back in. We're back in oil at 72.50. We had oil at 72.50 earlier this morning. We played that short, and when it actually clipped along at that pace, and then it finally fell. It went down to 71.50. So when you make $1,000 a contract, obviously you take it off the table. We're a little bit under 1,000 a contract on 3 contracts that we started with. Now we have 2 more at 72.50, and we don't buy them when they go up over 72.50. We buy them when they come back down under 72.50, and it's skipping back up. So actually, at this point, almost want to give up if it goes over 72.75. There's no sense in giving up all the gains we had before, but we have different information now. So when I called the short this morning, it was because, where are we? So when we called the short this morning, what did we know? Well, nothing. All I knew this morning was that oil had gone up a lot. Oil had gone up from, oh, let's get a better chart. Hang on a second, sorry. Okay, nope, energy, oil. All right. So what did we know? We knew that oil had hit below 65 and had gone up to 72.50. All right, that's a huge move, more than basically $7. It's more than 10%. So realistically, if you say 65 is the actual line and you go times 1.1, oh, well, that was terrible. What happened there? 65 times 1.1. 71.50. So 71.50 is the 10% line. So when you're at 72.50, you're way over where you expect to be. So 72.50 was a good shorting line. We expected a retrace. And what I said here, not very long ago, is we're shorting oil at 72.50. Also with tight stops over that line. Oil inventories are at 10.30, and we usually don't like to play into inventories, but oil is up 10% in the past week, and it's not a for not a good reason, really for no good reason, I think I meant to say. And so we expected at least $1.50 rejection back to at 72.50 back to 71. So we were looking for 71. We didn't quite get it, but you don't not take $1,000 profit when you get it just because it's not a 12.50 profit, right? So we're satisfied with where we are. So on this first round, so we came back down. It actually did come down to 71. I mean, that was, if we go back to the 5-minute chart, we actually did hit the 71 line. That's exactly where we expected to go from 75.50, but that's not the timing I had. So the timing I had was I came in over here, because I wasn't up at 4 to do it the first time. So the time was here, and so we got back down to 71.50, close enough, and once it starts bouncing, you get the hell out of it. You know, once you lose that momentum, especially after a big spike like this, you know, if you're seeing support, you got to get out. And you see it coming along this line, support, support, support all the way through. So it's a good time to get the heck out of that thing. So now we came back to 72.50, took another flyer at it. Now I'm talking to you guys, and I should have been, well, like I said, since we already have a profit, I don't mind at 72.75, which is way up here, actually. 72.75 is way up here. That's about where I'd want to stop out. Realistically, if you look at the resistance of 72.80, and, you know, so that would take a $600 loss on 2 contracts at this point if we have to, you know. But again, it's just, you know, it's because we know now that the report was shitty. I don't know how it bounced in the first place. There's no reason for this bounce. So I'm kind of happy. So here you are right now. It's still at 72.50. You can right now play this short. All right. And that's because I'm sorry. So what do we know? And so after that, that's what I wrote before we got the inventory report. And then we get the inventory report at 10:30. It's so gigantic on my screen. I don't know how it is for you guys. Then we get the inventory report. Okay, so, oh, I'm sorry. There is one piece of information I forgot to share with you guys. API oil news. Here you go. So last night, API had a draw of inventory draw of 3 million barrels. This is what you got to pay attention to. So you understand that means the expectations of traders is that it should be a 3 million barrel draw. They expected a build of 2 million barrels and they got a draw of 3 million barrels. In the previous week, they had a draw in oil, blah, 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 oil prices. Does it say gasoline here? API, okay. A build in gasoline, they showed a build in gasoline and distillate stocks were up too. So build in oil, build in gasoline, and a build in in distillates, but a draw in oil of 3 million barrels caused it to balance out at net maybe 2 million barrel build. Okay, now knowing what we know about demand and the Omicron and what happened in the past week, and don't forget that the week ends on like last Friday for oil and the Thanksgiving holiday, and we were talking about the Thanksgiving holiday and everything else and how many people traveled. You got to take all this stuff into account. But all the holidays have been disappointing for oil, all of them. And so these guys were expecting a lot better. And that's the thing. Expectations were high and it was already baked into the price. This run obviously already baked in very strong demand. Anything that wasn't strong demand was going to be a disappointment, especially after last night's API report. Therefore, I felt good about shorting it. I felt it was a high percentage play. Also, in addition to that, though, we had, of course, the run is already priced in. So given that the run is already, that it's already up 10%, that there's no indication here the demand is coming back in any kind of spades or anything like that, there's no reason to think that this is going to hold. Although Christmas is around the corner, and that kind of that's here it is, EI. Excuse me. So Christmas is around the corner, and that's going to let them jack up prices anyway. So it goes to December 3rd, which was Friday. Is that right? Yeah, Friday. And I guess you probably can't see this that good, so I'm going to make it bigger. Here we go. So always make sure you're reading the right one. Crude oil, 6.5 million, blah, blah, blah. And it decreased by 0.2, and this went up by 2.7, and that went up by 2.9. So basically, the 3.9 and the 2.7 is 5, 6.6 minus 2 is 6.4. So overall, you have a 6.4 million barrel build. That's a lot. So now we want to say, oh, wow, that seems like a lot. So did we... did the refineries, did we make more oil? No, we did not. We did not make more oil. We did not refine more. The refinery utilization was roughly the same. We didn't make more gasoline. I mean, yeah, it's, this is 100,000 less, this is 100,000 more, but it's not a big thing. And these are per day numbers. And it was the exact same amount of distillate. So we made the same amount of distillate, we made the same gasoline, we made the same oil, but we had a build of what was the number we came up with? A lot, right? It was a lot. It was 6.6. So, or 6.4 minus the thing. So we had a 6.4 million barrel build despite no change in production. Same thing with products supplied. The week before, we supplied 20,700 a day. Now we supply 20,800 a day. So there's no change in refinery activity, there's no change in product supply, but there's a huge build in oil. 6 million barrels is a lot. We only import 2 million barrels a day from the Middle East. That's all we import. We only import 14 million barrels, and half of them we didn't use. Means OPEC has really no effect on us whatsoever. Did we release oil from the SPR? Yes, we did. We released 2 million barrels, 602 to 601. So some oil was released from the SPR, but very little. And even if you subtract that, it's little. Now, look what else happened though. We exported less. we exported 300,000 barrels a day less. That's 2.1 million barrels less exported. So that also helps to cause a build. So that's how you say, well, where did these numbers come from? Well, we took 2 million out of the SPR and we exported 2 million less barrels over the course of the week. That's 4 million. So really, on the whole, it's about 2 million barrels, 2.5 million barrels worse than last week for demand. But there's no other way to slice it. You have to say demand did not increase. And if demand didn't increase, you've got a problem supporting prices. Demand did not increase. And not only that, but demand did not increase when oil was this price. Lowering the price back to $66 a barrel did not increase the demand for oil. This ended December 3rd. Now, obviously, it doesn't really, it's what people see at the gas pump that matters, but it's the same thing. This is substantial. Gasoline prices went down 10%, and it did not increase the demand. That's not good. That is not a premise for sustaining high oil prices. So you're going to see a longer term effect of traders thinking this through and saying, this I can't support. So, and also we haven't got any particular announcement from the Saudis. The Saudis did their announcing last week. This is how they drove prices up by raising the price. And they raised the prices they officially charge for oil, which is really has nothing to do with the free market for oil. And they didn't put supply back on the online in any kind of quantity. So that gave them the onus, that gave traders the onus to push oil prices back up from what they consider a floor. Now, if we go to a bigger picture, okay, oil had been consistently, if we're going back to 17, oil is generally $60 a barrel. Boom, 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 right? All the way across, somewhere in the six, somewhere in this range, obviously 50 to 80 is oil's range. More around the 60s though, and certainly not 70. You can't say 70 is the average, right? You look at this chart and say, you could have to argue 60 is the average. Oh, excuse me, falling apart. I'm tired of sneezing. Let's see. So let's say 60 is the average in the base. So we came down, we went up, we tested 60, we come back up to 80, we come back down, we almost test 60 again, and we're bouncing, but I think we're bouncing, we're going to trend a bit lower. But Christmas being the wild card is the problem, because into December, they try to jack up oil. Here's November, December. See how that is? That's Thanksgiving to Christmas. Here's November, December. See that? And here's November, December. Wait, where are we? Here's November, December, and this went wrong. That was 18. Here's November, December, though, up again, right? And then it really collapsed. But that's a virus, so it's hard to say. But so here's November, December. So generally, in my experience, it's a jack up time for oil. So we're just playing for a quick dip, and we're not going to risk it into Christmas. But like I said, today was nice, and all we did was take advantage of what we thought was going to be a disappointing report. It went down. If I lose, I don't know how much we make, 3,000. So we made 3,000. If we go back down to 2,500, we lose 500 of the 3,000. What can you do, right? So I don't think we're risking much, and it's worth it just in case we have a better collapse. But my read on this is that we should be lower. I don't see how 70 is being supported right now. And the other short we took was the S&P off the 2,700 line, but that already fell to 46.75 and paid us a lot of money. $5,000 on 4 contracts, and that's done already. Because I mean, for God's sake, again, 1,000 a contract. As a rule of thumb, if you make 500 or 1,000 a contract on the futures, you got to be happy and take it off. Oh look, here we go. Now it's coming down again. All right, so we'll see how that works out. I'm not too worried about those. But that's how you play the futures. You want to play when it's definitely stretched, when you see yourself on the top of a channel on multiple charts, and you can say, I don't think this channel is going to hold. Now, as I said, the long-term channel tells me 70 is a top, right? The long-term channel says it might go over 70, but it won't stay there. The much longer-term channel would scare you, right? Because a much longer-term channel tells you, oh my God, you could be up at 100. But these were very unusual times. And it was never deserved. It was really manipulation for the most part when it was up there. And like I said, the big thing that's going on now is just everybody is cutting back their consumption, and it's hard for demand to come back when all these cars have better and better mileage. You know, and what do you call that? Cafe standards, right? Whoops. Cafe MPG chart. So the average fuel economy is what that is. Images. Oh, you need a recent one. Tools, time, past month. Who's been writing better recently? Ooh, look at that. Oh, what's that? Oh. Fuel economy. Well, all right, I guess that's a thing. So what they're saying here is that the weight of the car is blah, blah, they got a whole bunch of little things they're putting in here. But the bottom line is the fuel economy. So since 2000, okay, and since 2000, the fuel economy of cars has gone up and up and up. Now, what caused this? What caused that more than anything else was this. This is what happens when you jack up the price of a commodity to a ridiculous level. Notice in 2000, oil used to be 30 bucks a barrel. They started jacking the price up to $100 a barrel, and then it went down, then it went up, then it was 100. But it was 100 basically, or getting towards 100 from 2005, 2004, starting up on this track, all the way to 2015. So there were 10 years when oil was ridiculously expensive for the most part. I'm gonna forget that. That's what drove the initial demand, is from here, 2005, see what happens, 2005 to 2015, it's being driven by the consumer saying, I demand a car that gets me better mileage. I cannot afford to put gas in it. At the same time, President Obama in 2008, yeah, when was he president? 2008, right? So in 2008, Obama mandated better fuel economy, all right, which is something Al Gore wanted to do in, oh, I don't know, when the hell was he president? I never remember when people are president. There was, when did Bush get in? Bush got in 2001, right? So he came after Clinton and Gore. So here's Clinton and Gore. And you see how the economy is going down and down and down because we were having a really hot economy going into 2000. Everybody was buying Hummers. Remember that? Like, remember when like everybody had a Hummer and everybody had a giant car? We still do the giant cars, just aren't as giant as they used to be. But so fuel economy was going down. Therefore, our consumption was going up rapidly. And people who extrapolated said we're going to continue consuming more and more and more oil. And by the way, you know, gasoline consumption is only about 1/3 of all oil consumption. There's other uses for it, but globally it's about 1/3 of all consumption. But it's still significant, and also it doesn't mean because trucks and boats and planes and everybody else is also trying to do the same thing. So you'll see similar charts on other stuff. So anyway, so there was this point here. Al Gore said at some point around here, he said, we have got to stop people from doing this. We have to put a tax on oil, and that tax should go towards should go toward. He wanted to do $1 at first. Went down to it. He went from $1 to a dime. This is when gas was $1. And the Republicans said if you put a 10-cent tax on gasoline, it'll bankrupt the U.S. economy. When it was $1, that's what they said. He started out wanting $1. They knocked it down to 10%. They wouldn't even vote for that man. He wanted that money to go into alt energy resource at that time. So that amount of money at 20 million barrels a day would have been 2 million a day. So let's say from 1996. So let's say, well, what year are we in now? We're in 2021. That'd be 21 plus 4, 25 years. So that would be 2 million a day times 365 days a year times 25 years. So Al Gore wanted to put $18.2 billion into alt energy resource starting back in 1995, basically. And the Republicans said that would bankrupt the country. So meanwhile, now we didn't do anything about it, and now gasoline is $4 a gallon instead, and it never did bankrupt the country. Is that billion or trillion? Billions, right? Billions. So $1 would have been $180 billion. That's what Al Gore thought was the right number at the time. But so anyway, so when Obama comes back in over here and we get the Democrats in control again, he says we are going to raise the CAFE standards and we want cars mandatory to get better fuel economy, whether people demand it or not. And that's key. And he was right, because the technology, as you can see with the horsepower, the technology has kept up and we're able to have better fuel economy and more horsepower in our cars. And they're even bringing back the weight, which is why you're seeing a lot of SUVs again, because they've got such great, they now are capable of having engines with such good mileage that they can go back to having SUVs, even getting 25, 30 miles a gallon. And the CAFE standards means that the fleet that you sell has to have a certain amount of average miles per gallon, which is, God knows what it is, but it's like 35 now or something like that for the fleet. So CAFE standard. Okay, mandated versus actual. And that, like I said, this is where Obama came in and mandated higher standards. And then, of course, the auto industry said, oh, you can't do it to us right away and it has to take so much time to kick in. But we're at about 35 now and heading to 50. That's the point. But, well, actually, the bigger point, though, is that we're at 35 now. We're heading to 50. We were at 25. 25 is like, what is it? 20, let's say that was 27. So when you go from 27 to 50, you're using half as much gas. So as the fleet improves and as we use miles per gallon equivalent, oh, here you go, passenger cars, light trucks, there you go. See, here's how it kicks in. And we're at here. Oh, it's more than that. Well, I'm not sure what it is actually now, but this is what was proposed at the time. So as of 2015, that was proposed. I don't think Trump rolled it back, though. I don't think he actually got that done. And we're heading up, as you can see. Now, this is in rapid order, though. 2025, we're supposed to be at 60. And again, well, I guess we should probably look at a chart that was done more recently. What is that? Whoa. Oh, that's good. I bet that has a good chart. Okay, so approved fuel standards. I'm sure, sorry, this is too small. Oh, wait, it's got a plus. There you go. So we were down here, and then we changed the rules in 08. It took a while to phase in. See, phase 1 starts, and here's phase 2 that we're in now. Okay, so we're in phase 2 and we're heading to 50, and 50 in a couple of years. We're only a couple of years away from 50. That's pretty cool. But the point being that we're going to be consuming half as much fuel to go to the same place. So when they talk about demand for gasoline, these guys don't take into account the fact that you have more efficient vehicles. Having the more efficient vehicles means having more efficient vehicles means they're going to be consuming less mileage, and there's nothing OPEC can do about that. You can drive more if you could somehow convince. But of course, in the last couple of years, think about what happened. Nobody drove anywhere for a couple of years. But you can try to advertise and try to convince people to use their car more often to increase demand. But if they drive the same amount of mileage, and honestly, are we ever going to drive more than we did in the 60s and 70s and 80s? We were driving everywhere, and also because you had to do things in real life back then. Do you remember when you were a kid and you had to actually go somewhere to do something? Like you couldn't just sit in your living room and switch screens to be in a different, to talk to your friends in another country or whatever. It's actually, once upon a time I had to visit. You know, if I wanted to see my cousin, I had to visit her in England. Now I just pop on the screen. So, you know, there's very unlikely, and especially in ball games and things like that, we used to, you know, if I want to see the Mets, I had to go to New York. I mean, sometimes they're on TV, but it's like, well, you know, if you want to go see a game, you get in the car, you go. You want to go to the beach, you go. People now, they don't do anything. It's much harder to get people to get in cars and do trips. So I don't think we'll drive more than we used to back then. You know, it's a you know, my parents used to take us to parks. You know, we would take a trip and go to like a state park, and we would climb up a mountain and walk up the mountain for the weekend, and that was considered a good weekend. You know, if I try to do that with my kids sometimes, they're like, "Oh, Dad, you can't even get Wi-Fi." You know, sometimes they would do it, but mostly they were just like, "I've been there. It doesn't have Wi-Fi. I don't want to go back." Why do we have to go there twice? So, but the bottom line is, okay, so think about it conceptually, though. People aren't going to drive more per person. We aren't making enough more people. We talked about this a couple of weeks ago, so I'm not going to get into it. We're only making 1% more people a year. And in America, frankly, I don't even think we have any population growth, but barely 1% more people a year. So you're not going to have an increase in consumption based on people. You're not going to have it based on the miles they're driving. And you're getting it cut in half based on the cars they're buying. Every time they flip over their cars, they're getting twice as much mileage. So, of course, consumption will go down. And when you hear them tell you otherwise, it's bullshit. And the U.S. has the lowest mileage in the world is in the U.S. Every other country has higher standards than we do. The whole world is consuming less gasoline. And frankly, of course they are, because it's like $8 a gallon for gasoline in Europe. So of course people are purposely cutting back. You think you freak out when it costs you $100 to fill up your tank. Imagine when it costs you $200 to fill up your tank. Can you imagine if you were putting $1,000 a month into your car? I mean, that's just insane. That's why people are riding bikes. That's why people are getting mopeds. That's why electric bikes are becoming a big thing. That's why scooters are all over the place. They priced oil out of the market, and what they're playing around with now, it's just their last gasp of trying to like squeeze money out of the oil business. Doesn't mean that they can't jack it up, but over the long run, shorting it is a good bet when you're at the 70s. That's what the point is. Over the long run, it's generally a good place to short. All right, so back to that. Blah, 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 blah. What else did we talk about today? Oh, let's see if anyone's got a question. Nope, no questions. I must be doing really good, or nobody can hear me, one of the two. So back to the charts, these. So we're back to 4,700 on the S&P. So why did I want to short the S&P this morning? Because look at how hard it is for it to get over 4,700. It's a great shorting spot. This is why you play. When you identify a great shorting spot, this line right here, when you identify a line from which you often get rejected, look, this is your risk reward. Here's your risk. Your risk is it pops up here, it pops up here, blah, blah, blah. Here's your reward. Your reward is it goes down here, or it goes down here, or it goes down here. So your potential rewards are much, much more than your potential risk. If I got burned by one of these, if this happened and I didn't have time to get out, I would feel comfortable doubling down because that's back to your all-time high, and I don't think the all-time high is ready to be broken out. Usually you have to consolidate near the all-time high before it breaks out. You don't usually spike to the all-time high. So when you're near the all-time high, it's a great time to short. But 4,700 has been a solid, clear line of resistance. So this morning I said, I like this. Let's play this short. And then we got a nice dip, and we got out. And if it comes back to 4,700, I'm going to short it again. That's the way you play these things. So you try to identify a good resistance point to do it where there's not a lot of visible risk. All right, and that of course includes the fundamentals on it, where I don't think that there's any particular reason. Remember, we talked on Monday about it's a no data week. There's nothing going on. It's boring. There's no big data points this week. There's no Fed speak. What's going to jack the market up? Okay, are they going to, the only thing that they can do at this point now, as far as the Omicron, is to say it's actually good for you. It's like, oh, if you catch Omicron, you live longer. Like, what? How much nicer could they make Omicron at this point with the spin they're giving it? It's basically they're telling people like, oh, you want to get this? This is great, because they totally said there's nothing wrong with it, no big deal, nothing to worry about. Go ahead, have fun. So what more can they do to jack up the markets? China already did a stimulus thing. Biden can't even get his, there's no way Biden's going to come up with additional stimulus when he can't even get the stimulus he's working on passed. So you have to think, what would change this? Is Powell going to change anything? The Fed's got a meeting next week, not this week, next week. So meanwhile, that means the Fed can't say anything until next week. So the Fed can't do it either. Nobody can move the markets. And if nobody can move the markets, how the hell are you going to get to a new high? Not to mention the fact that we've already jumped 200 points, which is, and how much is 5%? In fact, so 4,500 times 1.05 is 47.25. So there you go. So the 5% rule is 47.25, and then that would be a 225 point correction times 0.2 is 45 points. So if 225 is top, that's 225. I'm sorry. 4725. 4725 minus 45 is 4680. Oh, and look at see. So 4680 is your week retrace off the run. In other words, okay, you have a run, goes from 4,500, the 5% run goes from 4,500 to 4725. Oh, it's way, because that's 20, so it's down here. So 4725 is only right here. And if we, so let's see, 4725 right there. See that? And you see how it works over there? So that's a fantastic spot to short, but we don't even think we're going to get that far. But if we do, I'm still not worried, because the retrace from 4725 is back to 4680. And you see how 4680 is a support line? Where is it here? Okay. And you see how it was over here? See how we consolidate around 4680 here? Because the math of the 5% rule doesn't change. It's not like TA. TA, you move your lines wherever the chart goes, you move the lines, which is how they try to constantly justify it. The 5% rule doesn't do that. The 5% rule says, here's where we are. These are your major support lines. They do not change. And that's why I know when we get to 4,700, today is a good day to short. Okay, I waited. We didn't try to short anything until it got here. We waited patiently. Get to 4,700, we start shorting again. Just like I was shorting and shorting here. And what I do wrong? What I did wrong was on where was Thanksgiving? Here, right? November 26th, I guess. No, well, frick, it was one of those days. Yeah. So I think it was Wednesday the 24th. Oh, I know what it was. We got down here and we cashed out our S&P shorts because I didn't want to risk the holiday. And I was right not to risk the holiday because it did come back up when the market closed. It went shooting back up because the world markets were open. But then what happened is it completely went badoom and we missed out on the big drop. This is a big drop. I've been playing for weeks waiting for this, and by the time but unfortunately I didn't want to risk Thanksgiving when the markets I thought the futures were going to be closed too. I didn't even know they weren't, but I thought the futures were going to be closed too. I didn't want to risk it and then come back to who knows what. And unfortunately, what I missed this great big drop. So I also missed the aggravation of watching it go up to here. So either way, it's okay. I might have stopped out there had I not done it. So I don't want to say I would have played it perfectly or anything like that. But this is what we were playing for. The whole time with the S&P, I was playing, and I said repeatedly, I just want to make sure I have shorts for when we get a nice drop. And this would have been a very, very nice drop. This would have been massive amounts of money. Anyway, so now I'm back to that mindset where I'm trying to play and reestablish my S&P shorts for the next one. But like I said, because I feel that this is a weak retrace off 47.25, that's 46.80 is a weak retrace. The stronger retrace is going to be 45 points below that, so back to 35. See, and you can see the support. See the support line at 35 right there. So you see how historically how that works. So you can see that this is a valid line. So at 35, so the next retrace point would be 35. That's a strong retrace. I think, I mean, the closer we get to the Fed, the more trouble I'm going to be in. So you got to watch it. But I'm hoping we can get back to this 35 line. So far, 46.80 is holding, but of course it's holding. It's the weak retrace line. It's supposed to hold. If it doesn't hold the first time you test it, you're in big trouble. It should give you at least some support. The question is, how much support are you going to get? So we shall see. And meanwhile, you can get fancy and you can calculate the short-term support from 47, but you have to count it from where it should be, not where it is. From 47.25 to 46.80 is 44. Well, we know it's 45 points. That's how we got to that number in the first place. So it's 45 points, and that means you get a 9-point bounce. 45, 20% of that drop is 9 points, and that means what you're looking for is 46.89 would be a weak bounce off 46.80. And isn't that funny, right? 46.89 would be a weak bounce off 46.80, and 9 more points, 98. So 98 would be a strong bounce off 46.80. So in other words, I should give up on I should really give up if we go over that, but I think I think that we're still going to go below this. I think that this is going to come. I think that this is probably going to fail, and then we're going to fail 46.80, and we're going to go 45 points below that. And that's how the 5% rule works. It's just math. It's math, but you have to go back and back test the math to see if it is lining up with those points. And since this is lining up to the penny with what we expect, and that's a weekly chart, by the way, on a weekly chart, you're lined up to the penny, you know that the 5% rule is working. That's a very strong indicator that this thing's working. So, and we were long on gasoline, but we got out of that, I think. I think I took the money and ran on gas. Oh, there you are, 72.78. Went the wrong way again. I don't know what's making me sneeze. I hope I'm not getting sick. So NG we cashed. Oh yes, because we made $1,000. So NG we cashed out, taking that short. And we had 2 down, and we took a. I mean, again, it's $1,000 a contract. That's when you get out. It's not a, if you can't get out of it, if you can't be happy with $1,000 of contract profit in one day, you shouldn't be playing the game. So we got out of the NG. Sorry, so I forgot about that. And here's oil. Now the question is, what do I want to do with oil? If it's coming back to 72.75, do I want to get out, or do I want to play for more? And like I said, though, we'll see how it goes over the course of the thing. I think I'm more inclined to double down at this point than I am to get out. So we'll see what happens. And then bonds are doing this bond. Okay, so bonds are still losing their value. All the short-term bonds are losing their value. They're in the low end of their ranges. Go to weeklies and see how they look. Oh, wow! Look at that. Look at the 5-year note collapsing. Look at the 2-year note falling off a cliff. All bad. Okay. So by the way, so when you see this, it just seems like the 30-year note is probably going to start taking a dive. So if you want to, I mean, if you wanted to play this to drop 5 points, I think that's a very high probability bet, especially as you see the 5 years now below. And it's the same thing, right? It's a lagging indicator. It's a tugboat model. Who's behind? Who's lagging when everybody else is moving? So the 2-year is getting below their line. 5-year is below their line. The 10-year is about to pierce. So as soon as you lose 130 on the 10, you can bet the 160 is going to fail on the 30. Makes it a great short. Coffee has gone insane, completely insane. We used to play coffee at 100. In fact, here it is. So we would play coffee. I mean, all these preceding years, we played coffee whenever it was at the 100 mark. We would play it long. Now it's 244. I wish we would have. We could have just bought that, and we could have just bought that, stayed long, and we would own coffee plantations now. We'd have coffee plantations for everybody at this point. Sugar also. Both of these are bad weather. It's changing. It's the same reason that we had the premise back when it was 100. I said changing weather patterns cause droughts. Coffee is a very sensitive crop. Coffee does not adapt well to changes in weather. It can't be too hot or too cold or too dry or too wet. Coffee needs very specific weather to grow. And in fact, that's why you grow coffee on mountains. You grow coffee on mountains because at some point up and down the mountain, you find the right temperature band where the coffee is happy. You can't just throw it anywhere. It has to be in a place where it can be happy. So that's the problem here. Orange is also very sensitive. We haven't had detrimental weather in Florida lately or California that's been hurting the coffee, but watch the drought numbers in California for spikes. Gold and silver both weak. Silver is going to be playable down here as we're down. If we hit 22, you want to play silver long. 1750, you want to play gold long. Meat, I don't know nothing about meat. Honestly, no clue. Soybeans, again, not a real thing we play. I mean, just I think once or twice in the last 10 years we played soybeans, and one time we played rice. It's just not a thing. And how's the dollar? Ooh, the dollar's been very feisty. Now, here's the problem if you're shorting the indexes. The dollar is way up at 96, and it could, and don't forget this is a weekly chart, so this goes back far. So here's a whole year 2021. The dollar could very easily drop 1%, 2%, 3% without calling it even a major thing. And that would give the market a huge boost. So into the end of the year, they can knock the dollar down and boost the markets and give you the Santa Claus rally with or without merit. So we got to watch out for that. So, let's take a look at the Wall Street Journal. Who was, it was the guy in Network, Howard Beale, the movie Network. The guy was saying, it's a great speech, because he's saying, and he was a news guy, but he was, got radicalized basically. And he said, what are you listening to me for? I'm on TV. Everybody on TV is lying to you. He goes, this is a freaking circus where we sell products. And he goes, everybody's selling a product. This shows are being run by sponsors. They're not being run by artists. They're not being run by writers. Okay, everything is sponsored and everything is a product, and every word out of everybody's mouth is meant to sell you something, even on the news. And that was in the 70s. And in the 70s, it was TV was the circus, basically. But these days, all media has gone that way. And in fact, the point they were making about the TV is TV stations were being bought up by big conglomerates. Newspapers were still owned by independents. They still prided themselves on their independence. That's not true anymore. There's hardly any independent newspapers left. And there's no independent websites left. There's no independent anything left. All your information comes to you by corporations. Who bought the Huffington Post? Didn't AOL bought the Huffington Post or something like that? I mean, it's just ridiculous. And Time Warner bought AOL. So, it's like there is no independence. The New York Times is one of the last basically independent papers out there. And they're constantly being attacked, and in fact, the Rupert Murdoch's organization is actively trying to kill the Times. Their goal is to destroy the New York Times, because the New York Times is the exact opposite of what Fox wants. But meanwhile, and you've got to keep this in mind. This is my point. You got to keep this in mind when you are being fed information that it's biased and it's tilted. And you have to understand that not only is this information biased and tilted, but the information that they're getting is biased and tilted. They're getting information from a government that is sponsored by corporations. And these papers are sponsored by corporations. And what do the papers want? The papers want you to make their advertisers happy. Their advertisers are not going to be happy if you go back on lockdown. If the people start marching the street demanding that they be kept safe by the government, and demanding the government does more to stop the virus, including shutting down stupid things like restaurants and things like that nobody should be doing, movie theaters. How the hell are we keeping movie theaters open in any situation where you're not sure of a new spread of a virus? When they have when the salad bar at Bob's Big Boy gets contaminated, right? Or what was it? Was it a Chipotle? There was a Chipotle or something like that. That's like a couple hundred people got sick. They shut it down, don't they? Why? Because there's a virus. If there's a virus and people are getting sick, you shut it down. It's pretty freaking obvious. But there's a virus and people are getting sick, but because it's more widespread, they don't want to shut everything down. But that's what you do when a virus is spreading. You shut things down. You keep people away from spreading it. But nobody in the corporate media and nobody in the corporate government is going to tell you that, and neither are the corporations. So how is anybody ever going to tell you to shut it down? The only people who are going to do it are fringe people. People who are not part of the mainstream media. And you are being taught and brainwashed constantly to ignore those people. Because they're conspiracy theorists, because they're this, they're that, whatever. And yeah, most of the conspiracy theorists are nut jobs. Okay? But you have no outlet to say anything. I can't, We're Seeking Alpha. I'm sorry all over the place, but look at Seeking Alpha. Where I used to write, and I quit writing. I could write anytime I want. See here, Phil Davis, profile, blah, blah, blah. Oh, no, that's not it. Where am I? Watch, they cut me off for talking about this. Here, see, contributor center. Okay. I'm still a contributor technically. I can still write anytime I want to. I have not written an article since September. Before that, May. Okay, it's like I don't write for them anymore because it's too annoying. Because the rules that they have, because you know, when you write something, it's all edited. And it's edited for latest news. Well, I have to find, the problem is you can't even find it because everybody toes the line, but let's see. I'm just trying to find one of their disclaimers. Because God forbid you say one word about, and I don't mean even something, come on. See, nobody does it anymore. This is the thing. Anyway, so if you say anything about politics, they slap a disclaimer on the thing to say, we apologize for the political content of this, blah, 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 blah. And please don't be mad at us because we said something about one of the political parties or mentioned something. It is insane. But anyway, so the thing is that if you're an author on Seeking Alpha and you want to get something published, you have to toe the line. POLIT. Let's see. Political football. Theory. Here you go. I love this. Theory is, we recognize that politics often intersects with the financial news of the day, so we invite you to click here and join a separate political discussion. It's so ridiculous because they don't want you to say anything that's in any way controversial. And these authors depend on Seeking Alpha for their income stream. There's most of the people who write on Seeking Alpha, this is what they do for a living. They're freelancers, but Seeking Alpha pays you per clicks and things like that. So if you go to a contributor center, they pay you piss poor amounts of money. But see, that's interesting. This month. Wait, what? Oh, no, there you go. That makes more sense. Okay, so this whole year I got paid $50. But you know, people who you know put the tags in and do the right thing and so on and so forth, you can make not a huge amount, $500, $1,000 a month writing for them. I don't think you can do much better. Or it says here the site average per article, and notice how it drops. It's always dropping. So the average per article is $83 if you write the kind of articles, and most people write the kind of articles that they want you to write, which is promoting a certain you know, positive on Tesla, blah, blah, blah. Here's my analysis, blah. And then they push that out all over the place and you get a good amount of page views. But it has to be one topic, one thing, no politics, blah, 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 blah. So everybody is censored. Everybody everywhere is censored. And, you know, even the internet, which is supposed to be this free and open place where you can discuss things, is censored. Because in the end, it all comes down to money. In the end, you know, I used to write for the Huffington Post, and the Huffington Post used to be great. And I wrote for free, and I didn't expect any money for it. I mean, just, you know, you got a lot of traction. A lot of people do it. But what does the Huffington Post do? They sell out. They get a big fat offer from a corporation, and they sell out. And what do corporations do? They gobble up all the free and independent sites. So when you're an author, you try to write for this one, you try to write for that one, you try to write for this one, and they get gobbled up one by one by one by one. They get taken from you, and you no longer have an outlet. So there's nowhere left to write for an independent. So you either learn, and if you need the money, you'll learn pretty fast. You either learn to toe the line and write your neutral articles and not show your opinion and write what they want and don't be controversial. or you have to go to others. You're just constantly skipping to other sources, which eventually, if they get popular enough, they get taken away from you anyway. And obviously, it's very hard to build a reputation if you're constantly being shoved to another place and another place. So keep that in mind when you are reading the corporate media. Now, obviously, the Wall Street Journal is leans to the right. So when you read an article in the journal, you'll see them use keywords and so on and so forth. So Pfizer says boosted neutralized Omicron strain in testing. If you read more about this, you'll see that the booster, the third booster shot, is effective against Omicron. That is true. Okay, but that is based on one set of tests that have just come in. It's the first preliminary test, and they don't have any real conclusions from this thing. The Pfizer CEO also said something that this is an indication of how dangerous COVID is, and we can expect it to be around for a very long time. They're not going to talk about that because that doesn't fit their narrative. Meanwhile, the Senate is trying to, everybody, all the Republicans are still trying to knock down any concept of like having vaccine mandates or any kind of work-related things that require people to have vaccines, which I don't know when having the right to infect people became a God-given right in America. I really don't get it. I mean, I guess, if your kid has smallpox, I guess you have the right that they have the right to go to McDonald's and serve you, right? Because, God forbid you should tell someone they need a vaccine or they should stay home. Well, they can't work with an infectious disease, right? Let's just get it over with now. I mean, so Biden rules out unilateral force if Russia invades Ukraine. No shit. Could you imagine going to war with Russia over the Ukraine? They live there. That's their backyard. We're gonna go all by ourselves over there. So I don't know what they're trying to say there. Beijing reigns in the China Central Bank. What's that? Never been politically independent. Blah blah blah. Nation. All right. So Z is really becoming a dictator. It's interesting. I'm just trying to find something important that happened. Nothing important happened. Crypto testifies before the thing. All right, so fine. So, you get that there. So then the New York Times, you wonder if, I always like to look at them side by side because in the New York Times, they're going to have different articles. So we live in the same world. We should have the same news, basically. So Pfizer, again, offers significant protection against Omicron. Schools are going online Friday. Parents are furious. Which, I don't know. What's wrong with that? Oh, that's interesting. They're gonna cut Fridays. Well, I'm all for that. That's great. Britain announced major new restrictions urging people to work from home. How is this not in the Wall Street Journal? Think about it. How is this not in the Wall Street Journal? Isn't this like a massively important thing? A high number of Americans quit jobs in October. That's something else. Why is that not in the journal? Why? Because it's not beneficial to the corporations. They don't like that. January 6th. Oh yeah, there's a whole January 6th commission thing going on. The Wall Street Journal doesn't know about this. Somebody should tell them. Britain said it will not send top officials to the Olympics, blah, blah, blah. Merkel's gone. Also wasn't in the journal. That's interesting. So I think, so for me, I always read the Times and the Journal, trying to get like the whole picture and trying to figure out what's actually happening. It should not be this hard to find out what's happening, but you have to look at things from multiple ways. And that's why you guys see when I'm reading, in the mornings or whenever I'm reading, but Oh, you can't tell what articles these are from. They're all from different places. This one is NBC News. This is CNBC. This one is The Verge. This one is Business Standard. This one is The Atlantic. This one is from Flipboard. This one is CBS. This one is Discover Magazine. This one was Mashable. This one is Digital Trends. This one is, the Conversation. Well, I like The Conversation. It's really good. That's Flipboard again. NPR, that one is. I know, NPR. Huffington Post. What a liberal. What a liberal reads this stuff. Flipboard, NBC again. So, so when I'm reading, I read a lot of different things, trying to get like a sense of what's actually happening. It's hard. It really is hard because what's real. And when I pick an article, I try to pick what I consider the more realistic viewpoint, because there's various viewpoints, and I want to, out of all the stuff I read, you guys get maybe 1 out of 10 articles that I read. So I try to pick the ones that I think were the best written, and also the ones that convey the information in a good, in an easy to digest fashion. And of course, ones that I think are worth reading in the first place. So they're either going to be something that's interesting to me or something I think is part of what I consider market moving. So maybe we should look at what kind of things I consider important. I'll make a comment on why. So Texas pulls 400 books from the library shelves. I mean, these are things you need to. Speaking of censorship, right? You can't even read stuff. So we're into 1984 now with a book burning, or what was that one? Fahrenheit 451. Diallo thinks an economic disaster is coming. The Amazon server outage. Holy crap. Think about how much we're starting to depend on Amazon Web Services, and everybody's like, Amazon Web Service, what a great growth thing. Meanwhile, they go out and we're screwed. You are heavily encouraged to put your website on Amazon these days by programmers and stuff. And it's now a single point of failure for the internet. Meta's blah blah blah. So Meta's growth. We are interested in that now. Now we have to be interested in the metaverse now. Whole nother universe we have to worry about now. This one's kind of falling apart, so we're all kind of moving to the metaverse on the whole. Housing market's turning ugly. There's a hut on the moon. This is kind of cool. I don't know if it's a hut, but we'll find out. Let's see. Continue CBS. Oh, please. Seriously? Freaking ads. Open in incognito is how you get rid of those. There you go. So now you don't know where. That over there. See that? I mean, they're gonna go. This is China. China's on the dark side of the moon. We've never been to the dark side of the moon. And there's somebody lives there. So they're gonna take a look. But that's all we know right now. And it's not like the Mars thing. They can't fly or anything. So basically, they're just gonna creep. This thing moves at like, I forget. They think it could be just a rock that looks like a hut. I don't know. The thing is, the rover was 262 feet. 2 to 3 months. It's going to take you 2 to 3 months to get there and check it out. It's so funny. But you know what? That's a really good way. If you want to sit there and disclose that aliens, there are aliens, that's a good way to do it, right? Say, look, there's something over there, and every week or so we get a little update that says, no, it actually might be a structure, and then eventually you get there. So it kind of eases you into the idea that there's somebody out there built something. Let's see. Oh, this is great. It's like, this is a really, really good book, The Dawn of Everything. And it's just a wonderful, wonderful book on human history that actually makes you rethink a lot of things that you thought you already knew. Very good. I got a problem with this. obviously important. We're getting better able to track the near Earth asteroids, but here's my problem. These are the asteroids. All these freaking lines are asteroids that are swooping around the Earth, right? Now, at the same time, we're testing our little intercept system so the rocket can intercept the asteroid and knock it off course in case something's heading towards the Earth. Also, a good thing on the surface. But now combine these two concepts, though, with how many asteroids are orbiting the Earth and your willy-nilly destruction of said asteroids. And what happens is, to me, it's like a domino effect. Like if you're going to sit there and knock an asteroid off course, these orbits, these non-hitting the Earth orbits, have established themselves over millions of years. The non-hitting the Earth orbits, a bare miss is still a miss. Okay, so this is the whole solar system, not just the Earth. But a bare miss is still a miss. And the point is, all the things that were going to hit the Earth already for the most part. Okay, so the things that were in an intercept course have intercepted over the course of millions of years, billions of years. The things that are left are in orbits that don't hit the Earth or other planets, or any, you know, they don't. These things are all a part of a weird. Like, look, Mars doesn't hit the Earth. Venus doesn't hit the Earth. Mercury doesn't hit the Earth. These are orbits you understand. This doesn't hit the Earth. This doesn't hit the Earth. This doesn't hit the Earth. They're all in stable orbits that don't hit the Earth or other planets. Like I said, that's why they're still in orbit. Otherwise, they would have crashed into something. Now, once you've messed around with one of them, what if you knock one off course and it bumps into another one and it shatters and it breaks and pieces hit another one and they start going and they start bouncing off each other? And now you alter the orbits of all these things. Now you take all these stable orbits and start causing chaos again, and then things are going to randomly start hitting planets again. So I don't think they're thinking this through. I really don't. I think they're all excited that they can hit an asteroid with a thing, but then what's going to happen to that asteroid? Have you plotted its trajectory in relationship to every single other thing that it could hit in the new trajectory you're sending it off on? I'm not happy. India is now experiencing dengue fever. So that's, their hospitals are overwhelmed and now they've got dengue fever because partially because of the overtaxed health system and so on and so forth. So anyway, all these bits of news are things that connect or are interesting in the first place. Now they're robbing hotels. You know, what's the upshot of this? It's all this robbery stuff. You got to start saying, well, crime is seriously on the upswing. We're hitting another wave of crime, and really nasty crimes too. Biden banking regulator withdraws. Now we have no so upshot of that, we have no banking regulator. These are things to keep in mind. Matt Gaetz wants to come back, and he wants to punish everybody who went against him. You know, electric batteries are evil. We know it's a huge toll on the environment for making the batteries. Pfizer again, blah blah blah. They're really pushing now. That's, by the way, they're really pushing this story. Who is this one from? When you see a story this often from this many different places, I mean, obviously it's important and people care about it, but you know, it's like they're really pushing you to hear this. They want to push that narrative out everywhere they can. Then we were talking about what I was just showing you guys before. Starbucks, you would think, would be worried about the fact that sugar and coffee are way up there, and maybe that's holding them back a bit. I mean, they haven't had a great year, been kind of flat. DocuSign has gotten their ass kicked lately, and somebody asked whether I thought that was a good buy down here, and I said it's not really a good buy. It's still 50 times earnings at this price. You know, and I think that if it wasn't for the pandemic, they never would have popped in the first place. So robot traders sold Moderna and bought Tesla and Merck. China, we know about this story, but see, it's funny when you see like something we talked about days ago is just hitting the news. This is Business Insider telling us this. Oh, this is interesting. So the UN wants to have a ban on using robots like, drones with machine guns and things like that. They'd like to say that's not allowed, and the United States is saying, "Oh, no, 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 that's our new toy." That we want robot dogs that can kill you. And I don't. I mean, come on, you guys have seen those robot dogs, right? Okay, so they're fully functional robot dogs. They can run pretty fast. They can go places. They can follow commands. So all I got to do is put a bomb on one, and then send it into a building and blow it up. So boom, suicide bombing dogs. All right, and you might say, well, that sounds cool. Maybe it's a good thing or whatever. But you've got the enemy can do this too. It's technology. It's going to be out there. The plans will get leaked. People will find out how to make these things. You're going to have murder and mayhem and carnage. I mean, it's bad. This is going to be bad. And then not just bombs, though. You're going to be able to you'll be able to have 100 robot dogs running ahead of the troops with machine guns, just mowing people down. Like running at like 30, 40 miles an hour and heading off into the battlefield and firing, and then also blowing themselves up when they get to a tank or whatever. This is going to be crazy. It's going to be cool, but it'll be crazy. And we won't ban it. We want that. That's what the U.S. That's our military strategy for the future. Flying boats. It's kind of cool. Gunlich had some good charts. Those were good. Goldman Sachs lowest GDP outlets. Of course, it's no effect on the indexes. They're going to keep going up anyway. A low GDP, so what? How's that bad for the market? VTOL, electric vertical takeoff and landing aircraft. So flying taxis coming soon. This is kind of cool. Beyond Meat. It's not Beyond Meat, but look, things are picking up, huh? They got the look. It might taste like crap, but they got the look right. So they can print that now. It's kind of fun. Coffee prices 10-year high. Small businesses are raising wages, which is why we are shorting the Russell, because inflation hurts those businesses. It's hard for them to jack up their prices quickly. A $3 billion casino in Manhattan, excellent. I'll take that. I'm a fan. What was it that they had though? Oh, a crypto trading pit. You're gonna gamble on cryptocurrencies at the casino. I love it. And a flying car landing pad. I like that too. So I'm gonna be a big fan of this casino. In Michigan, problem with unvaccinated people. SunPower, who we invest in, starts a solar home financing arm. Very good. Camilla Harris, I was just talking about that the other day. The U.S. mortality rate for women is horrifying. We're like a third world country, and because of obviously lack of adequate health care. Southwest is going to make money. Elon Musk doesn't want people to have subsidies, so otherwise they can. Elon Musk, who built his company on government subsidies, wants to stop the government subsidies now that he's big, because he doesn't want any of his competitors to get them. Oh, and this is totally cool. Look at this. It's a big bamboo. It's made out of bamboo. It's a big thing of wood, and they put water in it, and as the water evaporates, it creates a cooling funnel, and it works like an air conditioner. It sucks hot air goes out, and hot air goes out the top, and cool air goes out the bottom, and it keeps everybody nice and cool. It's kind of nifty. I love that I love this kind of stuff. It's like very, very good innovations. But then, so then we talked about that. Then sometimes we get to news that's actionable. So Thor, who make big giant RVs, they they're moving nicely. And so what happens when I read an article like this, Thor, and they've beaten the supply chain, and one of the ways they did that is they bought one of their suppliers. That's been very helpful for them. So they bought a supplier. They're managing their supply chain really well, keeping up deliveries. They've had North American RV 61%. Now, of course, last year was shit, so not a big deal. But 87% up on motorized RVs. European RVs up 5%, but they're not big in Europe. And they added Tiffin Group, which was a lot of the increase there. So they had a good acquisition and so on and so forth. And where is that? That's this thing. No, I don't want to see what's new. Get out of the way. THO. So then when I see something like that, I look at the company and I say, okay, so they're a $6 billion market cap. They've got, now don't forget it's an acquisition, but they went from 7-8 billion in sales. Now they're at 12 billion in sales. Last year they made money, didn't lose money last year, so I love them already, right? 660 million in profit, 724 this year, so increasing. So they combined the companies. They did 660 last year, so they did a really, really good acquisition and integration. Now they're at 14. They're going to go to 14.5 next year. They're going to make $700 million, and you're buying the company for $6 billion. So that's a PE of like 8. So this is great. And we like the concept because RVs are becoming more of a lot of people are turning to RVs for their housing needs. They're actually living in RVs. Somebody made a comment, 1020 made a comment that the RV sites are expensive, and yes, they are in certain places, but in other places they're not. So, obviously, if you go to a fancy national park or a nice place, you'll pay $50 a day, even $100 a day to park your RV. $100 a day is $3,000 a month. That's crazy. So there's no point in having an RV and then paying more money than you would pay in rent to park it. But there are places that are more like, $1,000 a month or less than $1,000 a month where you can go to a regular RV park. So you have to you have to know how to do it, I guess. I know when I'm in Washington, D.C., for some reason, it seems to be legal to just park your RV around the mall, like wherever you can get regular, anywhere you can fit your parking and park your RV. Apparently, it's okay because people just freaking go to Washington and park there, and they live out of their campers, which is weird. But anyway, good company, great growth, good potential. They're in a strong industry. Things are going well for them. So we liked it. It seemed like a good pickup, and we added them to, get back to the topic. So because of that, I said, and they're low in the channel, they're holding the bottom over here, so I like it. And I said, okay, so why don't we sell the 100 puts for $22? What does that do? That nets you in for $78, which is, 190, 80, 70, so sorry, 78, 78. So right down, so way down here basically would be where you're entering on the short puts. And we're picking up the 100, which is in the money, the 100, 130, which is not too ambitious. Bull call spread. This is over 2 years. So in 2 years, we want to get back over 130. And that's net $1,500 on a $30,000 spread. And your upside potential is $28,500, which is 1,900% of $1,500. So 19 times you can make on this spread if all goes well. And your worst case is you end up owning 500 shares at 103. That's this money divided by 500 shares, which is 3, and you're in at 100. So you'd be at 103, which is right about where we are now. But realistically, if you had the January, if you had sold the January 100 puts now for whatever for 20 bucks or whatever it was for 20 bucks. So now they're 330. Even if you had sold the 120s, well, it's too confusing. All right, let's say, for whatever reason you'd sold these things for only $5. Now they're 390 or whatever. Okay, where can you roll it to? Well, look, the 2024 75 puts are $8-10. So you can drop this thing 25%, and if you did a 2x roll, so we could buy 1,000 for $75 if we decide to roll them along, basically. I'm sorry, so not buy, sell short, sell twice as many. So realistically, it's a huge amount of premium, and unless the stock really drastically drops, we can always do a roll. Then 2025 will come out, 2026 will come out. You get even lower, better strikes, lower prices. So I'm not too worried about owning 500 shares of Thor. And again, what's going to go wrong with this company? Not something so drastic that I think it's going to go back to $75 or less. So anything over $75, it's not a big deal. There's not a huge risk in this thing. Where was that thing? Because even back here, 2017, 2018, they were making $400 $400 million, $300 million. So even if they go back to like $300 million, that's only 20 times the earnings here. So for them to drop lower than 75 would be crazy, crazy cheap. And it's not very likely. And even if they did, we'd be down $25 times 500 shares is $12,500. So that's our risk. Our risk isn't, and that's the thing people do a lot. The risk isn't that you're going to own $50,000 worth of Thor, because you're not going to lose $50,000. Most likely, obviously, anybody can go bankrupt, but it's very unlikely that you're going to lose 50,000 bucks. Maybe 25,000 in a complete market collapse, you might get down 50% on this thing before you have to give up on it. But then you say, well, $50,000, that's a reasonable allocation block in the portfolio. So it's not a very risky trade. That's why I put it out as a top trade alert today. Oh, and that brings us to something else I wanted to talk about. Great. So we had that became a trade, and I sent out a top trade alert. Then we had the oil inventories. Oh, and then I said, oh, look how nice this thing is, right? Although I would want way more comfortable furniture. I mean, this is a basic, you guys see this crap in Best Buy. I would want something more comfortable if I'm going to be living in it. That's kind of cute, right? That's your driver's seat and turns around and becomes part of the living room. And look at this fridge. I mean, that's that's a serious fridge. I like that. I'm not sure of the microwave up there. I would want an air fryer. I think you should somehow get an air fryer built in, or get one of those microwaves that does that too. And then it was webinar time, so that's where we're up to. All right, good. So we covered that. What else has been top trades? That's what I wanted to talk about. So this morning our top trade was Thor. And we like that one. Cleveland Cliffs was on December 2nd. And we'll take a look at how they're doing. All right, so Cleveland Cliffs, they make iron ore pellets, which are used in a lot of stuff in the steel making and everything else. So, and they make it in the U.S. This is the thing, though. It's iron ore pellets in the U.S. There's not really any competition in the continental U.S. or even in North America. So they have a huge advantage, and with shipping where it is and delays and so on and so forth, I would think they'd be doing way better. I'm surprised that they're as low as they are, which is why we picked them on December 2nd when they were down here at 20. When they hit 20, I was like, screw that, got to buy that. And again, it's just, you got to just look and say, am I crazy, or is this company like being way undervalued? And you would think they got to be like not making money or something. And yeah, last year they lost $122 million. But you know what? This year they're going to make $3 billion. That'll take care of that loss. And then the infrastructure bill kicks in and they make even more money. And you buy the whole company for $10.5 billion. This is crazy. Why do people not see this? I don't, it really does bother me sometimes. Sometimes I look at these things, I'm like, how is it that this company can be priced like this? They literally in 3 years, if 2023 is $3.5 billion, they will literally in 3 years return the entire market cap of the company to the investors. 3-year turnaround, 33% a year of your money back. That's really good. So, and what's going on? We're passing a $2 trillion infrastructure bill that's going to kick off projects that are going to go on for 3 years. So, and again, you might be able to get this stuff cheaper in Asia, but iron ore pellets are heavy and shipping them is expensive, and that keeps Cleveland-Cliffs very cost competitive. That we always used to buy them when they were cheap. They used to be more erratic. We would put up with this kind of erraticness. They would lose this kind of money, and then they'd make some money, and then they'd lose some money. That's fine. They're a cyclical company. That happens. On the whole, though, they were a decent company for a good price. Now it's stupidly cheap. Now it's gotten, I mean, look at this price to book with price to earnings, 3.6. So, you know, that's just way too cheap to ignore. So, of course, boom, top trade. Oops, what the hell? So, yeah, Cleveland-Cliffs key person buys 500 shares of stock. So the key person is the CEO. And I was just saying that about another company. There was some other CEO. The DocuSign CEO. He bought some too. You have to. I don't put a lot of stock in this stuff, especially when somebody who's got, he's got millions of dollars. And you just look at how. In fact, here you go. If you ever want to check, although it doesn't track every single person, but you say the guy's name, Control V. Net worth. He's probably not famous enough to be in there. Oh, no, there he is. He's got $115 million. All right, he has 50,000 units of Cleveland-Cliffs worth $100 million. So most of his money is already tied. So here's a guy, just like Elon Musk, same bullshit, right? His 90% of his net worth is Cleveland-Cliffs stock. And so he announces that he's buying 50,000 more shares at this price. It's not a valid thing, okay? He already owns it. His wealth is tied up in it. The price goes down, and he has a publicist say, oh, he bought more stock. But I bet you he sells it again in a few months when he needs the money again. They want him to buy it. Elon Musk does this all the time. Whenever Tesla would go down, he would announce that he's buying stock. And that's what the DocuSign guy did too. That was some hell of a load of crappy stuff. I had to ask my lawyer. This is what the DocuSign guy says. I had to ask my lawyer whether it was okay. I couldn't believe I was allowed to buy my own stock at this price. That's what the DocuSign guy said. It's like a joke. People just read this stuff and think it's real. So very silly. How do I get to here? Oh, there we go. So Cleveland-Cliffs. So it wasn't about that he bought the stock. It just made me look at it, and I was like, holy crap. I'm like, that's really good. I mean, this was a lot more of a concern to me than that. Was the stock was ready to outperform at Wolf on steel pricing strength. All right, so we made them a trade, but we only played them to 22. We're not going crazy. I said they would get to 22 in 2 years. They're basically at 22 now. This is a $3,000 spread that pays $35,000. And I said it's $25,000 in the money. It was $25,000 in the money when we took it, because it was at 20 and we took the $15 calls. I mean, options are crazy. It's just really, things get so mispriced that it's ridiculous not to take advantage of it. Why would I not want to buy this thing when I'm buying for $3,000? I'm buying a spread that's $25,000 in the money. So how much do I hate Cleveland Cliffs that I wouldn't take the spread? That's how come it becomes a top trade. I can't even come up with a rational argument for not doing this. And here's TD Bank. Why? TD Bank raised their quarterly dividend by 13%. They're buying back 50 million shares. Now that's a little bit more significant. They're buying back their own stock. They're paying a 4% dividend, which is very nice. I already know they're a fantastic bank. We play them once in a while, and we like them all the time. So even though, and again, this was December 2nd. That was also December 2nd. So even though they were down here at 72, or I mean, sorry, not even though they were up here at 72, really, they came down from 75 to 72. But that was enough for me to say, you know what? It was mostly because we could take advantage and sell the 70 puts for a good price. So because we got the 70 puts for 850, which is net 60, 150. So even though we got we were able to sell the 70 puts for a good price because of this drop, it jacked up the price of the 70 puts. That's what made it a good trade. So we got a good collection here. But in this case, we spent a lot of money because I was not super duper confident. So I wanted a 60. This is a 60-75 spread. And we even sold 5 short calls because I don't really think we're going to be much over 75 in the near future. So in this case, we sold the 70 puts. We took the 60-75 spread because I felt it would go back, and it did, of course, already. But I don't think it's going to go much over. So we sold the short 75 calls, just a 1/5 coverage. And the net of that became 87.50, but it's a 37,000 spread. So it has $28,000 upside. And again, great trade. I love TD. I don't think it's going to go lower. I think it's been under recognized. And here you go. When you look at the numbers, so, you know, we see a potential catalyst and we do our research. This cannot be them. What's the problem with you? Doesn't seem to want to. TD. It refuses to go. Oh well. Anyway. I think I am getting sick. Now my throat. Okay, so 74.50 is $130 billion, and they're making 14 billion a year. So once again, you're not even a PE of 10, and it's a rock steady bank, really good bank. Very much they're half of Canada banks at TD. December 1st, because the market was dipping again. And where is that? Futures. Indexes, S&P, daily, hourly. There you are. When did we do all this buying? December 1st. Why did we do all this buying? Look what was going on. Things were going on sale. While things are going on sale, we're buying. December 1st and December 2nd were all these top trades. Because when something is falling like that, we jump in and we start buying. And that's why you got the sudden spate of activity. Viacom, Intel, Philip Morris, WBA, and IBM. That was our trade of the year day, basically. And then here was IBM from November 30th. And again, you go back to the futures and say, why are you doing that? Well, November 30th, the S&P was down here. So what's my first choice is what turned out to be our stock of the year is IBM. So we were thrilled to buy IBM down here. Then the next day I was like, oh, screw this. I got a whole list of things to buy for this price. And notice it was 1 p.m. in the afternoon when things started getting really cheap. I said, let's start buying stuff. And the nice thing is, though, we had all this time at the lows. So from well, I don't know what time this is. So as things fell down, we had all these days to buy with the up and down action. And like I said at the time, we were talking about the fills. It's when you're down here, you wait for it to come down and then you buy the longs because you want to be long. So you start by buying the longs and then you sell some shorts. And then if it comes down again, you buy some longs and then you wait for it to come up and you sell some of the short calls. You got to time it with the motion, because this is what happens when you're bottoming out in the market. So if we called a good bottom, that's what you're going to get the chance to get some really excellent fills. Then on the 29th, we had done Beyond Tech and Beyond Tech and Delta. Well, and Delta's probably doing really good right now. Yeah. Although it's only really back to where it was when we started, but so we felt that was going to be a bottom of Delta. They came down and they popped back up, but that's fine. I mean, we figured that would be the bottom, and it kind of is. So it's all we care about. Do we have a good entry? And then before that, we had reviewed the top trades before Thanksgiving. And then we had AT&T. That's got to be. Did they stop going down? I don't know if they haven't stopped going down. Oh yes! Wow, look at that. Okay, so great. So AT&T finally stopped going down. We thought it was done. The WBA, which I picked again. I keep picking it every time. It's like another one I can't figure out how people aren't buying this thing. And then earlier in the month, SunPower, but SunPower since November 3rd is down considerably. So you can do a lot better on this play. Let's see, future is now. So that was what we have in the future. Well, that's not much of a. So that's got to be killing our future is now portfolio. La-di-da. Well, here it is. SunPower, yeah. Well, actually, I mean, it's still positive. It's interesting because we've had it for so long. We've had it since May. Would I adjust it here? It's at 24. We have the 20-35 spread. No, not really. Maybe take advantage of it being down in the channel and roll these 20s to the 2024 and just buy some more time. But I still think that 35 target is going to be accurate. SPWR. I don't see 35 as being out of reach over the next year. And frankly, even if it isn't, then it expires and we sell some more calls. So I still like that. I'm probably going to make an adjustment on that one. Ooh, Tom says you can park overnight at Walmart anywhere in America in an RV or camper. No kidding. That is an interesting concept. And how many Walmarts are there? There's got to be 1,000 Walmarts. We have more Walmarts than there are days, so that'll work out. Go from Walmart to Walmart, town to town. Well, that's damn decent of them. I like that. All right. Anyhow, so time to wrap this up, and just wanted to go over that stuff and talk about where we are. We are. How's our thing doing here? Yeah, see, oil's kind of staying under 72.50, so I'm not going to worry about it right now. I'm going to let it play out because I think we're going to have a little dip at some point. The S&P we're out of unless it gets back on 4,700. Then I'm going to add 2 more shorts back there, but I'm going to play those with a bit of conviction, as from what we talked about earlier on the lines. So the 2 I'm sticking with here are oil and the S&P, and the other one I was liking was natural gas, but I think. Yeah, if they come back down to 380, I'll play them again, but I don't want to chase it because it's a little scary to chase. It's really volatile, and I already have an oil trade going the other way, so I'm not really keen on jumping back in. But so oil, like I said, 72.50, and we were playing for a we're playing for at least a $1.50 back. So we really want to see 71. I'm not going to, 71 I would like to see on oil. That would be the retrace I'm looking for overall. And we have that this morning. That's from here. But I'd like to see it again hit 71. And if it fails 71, then we get another $1.50 down. So we're going to end up at 69.50, which is actually, see this line here, it's very close. 69.50 is where we'd be looking for. That would be probably the best we can expect on a pullback. And again, dangerous into the holidays. They have a lot of ways to jack it up, but we'll see what happens. All right, so that's where we are. It's a good, boring week. Next week will be more interesting because we have the Fed. But for now, we're just, playing with the futures and picking up a few stocks, all right? So everybody go out there and have some fun. And we'll do it again next week. Thanks.